Have you gotten to the point in life where you're thinking about retirement? If so, here are 5 things to consider before you take the plunge. My name is Ryan Wheelis. I'm host of the On the Money YouTube channel powered by Allied Wealth. Thanks so much for stopping by. If you like the content we're putting out, give us a like down below. Hit the subscribe button as well. Feel free to comment as well, and we'll keep you updated when we send out new content just like this. Okay, so you're 10 years out from retirement, 5 years out from retirement, whatever that number is, and you're starting to think, what should I be doing? This is a short checklist, 5 things that you should be considering before you take the plunge. And the first thing is really going to be setting a date, right? Have a goal in time and have that set in stone. And the reason why you want to do that is if you have that goal, you can take advantage of a lot of planning opportunities. And what I mean by that is a lot of times we see folks that waited too long to do this. But they saved all their money in a 401k. They saved enough money in their 401k to be able to retire, but all their assets are very, very retirement account oriented. For instance, if someone's got a large 401k and a large pension, that pension will come over to out of the pension usually go over to in a lump sum to an IRA. So now the 401k money also gets rolled over to an IRA, which means the money that they have is subject to taxes. So every dollar they would draw out of those IRA accounts from the pension rollover and the 401k rollover are 100% taxable, right? So it's very difficult as an advisor to help somebody do some good tax planning if they don't have a good composition of accounts. So to be helpful on that, if that's you, what I would consider doing is taking some advantages. One advantage might be, hey, let's make sure we're putting in enough into our 401k still to get the company match. But let's start building up a war chest outside of our 401k and retirement accounts, maybe in some bank accounts or some brokerage accounts. So we've got some dollars that aren't taxed when we need them the most in, say, an emergency, or maybe we'll take a vacation at the end of the year or something like that. And that can really help us control the amount of taxes we pay throughout the course of retirement. Another example might be, hey, if you're 65, you can start doing Roth IRA conversions and doing some planning now so that we hit 75 years of age, 74 years of age, 73, wherever you fall for the RMD new ages. What can happen though is you maybe have been able to do some good tax planning along the way, and that can really help reduce the required minimum distributions. Because what has happened, by the way, folks, is with RMDs, the age has gone up, but what has not changed is the table they use for withdrawals. So those withdrawals at 75 can start going, be pretty big and start growing rapidly from there. So some things to consider is composition of accounts. Consider saving some money outside of your 401k. Make sure you put enough in the 401k to get the free money, the company match, right? But consider saving some money outside the 401k as well, all right? The next thing is estimate your retirement income and expenses. And this is an interesting thing for me because I have so many people that say, Ryan, I make $100,000 a year, and I obviously need $100,000 a year in retirement to live on. And the reality is, folks, you probably don't. And here's what I mean by that. Let's assume this person with $100,000 a year retirement goal makes $100,000 a year now, okay? But they're also saving $20,000 a year in their 401k plan. Well, guess what you stop doing once you retire? You stop saving. So that $20,000 a year you're putting away in your 401k plan, you're not going to be putting that away anymore, right? You've been saving that. So that automatically means you can cut down to $80,000 a year in income in retirement because you're not saving the additional $20,000 a year into the 401k. Now, there's some caveats to that, right? Because if that was you, my next question would be okay, are you saving money in addition to the $20,000 a year you're putting in the 401k? If you said, no, Ryan, I got credit card debt out the wazoo and I've got a big mortgage on the house, and I would say you're not in a situation to where you're going to be able to reduce your spending from $100,000 down to $80,000. But it doesn't mean we can't do some things around that to help mitigate those expenses and get that number down in the future. That might be a consideration of working 2 more years to get your debt paid down or something like that. A lot of levers we can pull, folks. And the whole purpose of the channel, by the way, is you thinking about this stuff. But going back to this, if you make $100,000 a year now, there's a chance, and you're putting $20,000 a year in your 401k, there's a chance you only need $80,000 a year in income in your golden years, which is pretty cool, by the way, all right? Another thing to think about, expenses. And expenses is one of these things where nobody likes doing a budget. I mean, who wants to do a budget, right? But it is important to at least do this. Separate your non-discretionary expenses from your discretionary expenses. And non-discretionary expenses are things like food, water, shelter, clothing, access to health care, transportation, utilities is another one. And just think about it from this standpoint. What are the bare necessities I've got to have in my golden years to have any quality of life whatsoever? And then let's look at our living expenses, meaning our non-discretionary expenses, in the sense that, those are things like another vacation, adding a wing on the house or a room on the house or a pool in the backyard or the RV or the car, whatever they may be. They're more discretionary expenses and they're not required to sustain life in your golden years. Look at those things in two categories. The next thing you want to do when you have those two expenses divided is consider how to fund them. And there's a lot of ways to fund those expenses. But I like to use guaranteed sources for my non-discretionary expenses and use market investments for my discretionary expenses. It's a good idea to do it that way for a lot of reasons. Some people like to do it that way, some people don't. But again, the whole purpose of the channel here, folks, is to get you thinking about this stuff. Other thing, when we're talking about someone who's got $100,000 a year income goal, okay, and I prove to them, hey, you don't need $100,000 a year. You actually need $20,000 less. You need $80,000 a year because you're putting $20,000 a year in your 401k. Another thing we can do to really help maneuver things in the plan is let's develop a phased income plan. And what I mean by a phased income plan is this. You've got your go-go years, and those are the first 10 to 15 years of retirement. You've got your slow-go years, that can be the next 10 to 15 years of retirement. Then you've got your no-go years, which could be the last 5 or 10 years of retirement, right? But the bottom line is in your front years, you want to front load those because you will do more in your front years than you do in the middle years, and you'll do less even in the latter years you do in the middle years. Now, one thing to worry about along that planning thought process is a long-term care issue or expense like such as that coming out later in life. But most people will go a go-go, a slow-go, and a no-go year retirement plan. And what that means is in the slow-go or in the go-go years, maybe we need $80,000 a year. In the slow-go years, maybe we go down to $60,000 a year. And in the no-go years, maybe we go down to $50,000 a year in expenses. The bottom line, though, is a lot of people think that retirement spending is linear. And in fact, we see a lot of times it actually kind of goes up like this in a curve and begins to go back down the other way. And when it starts going down the other way, that's the peak of your go-go years. And folks, you should go hard, go fast, go strong, have a blast, live a great retirement. You absolutely have worked for it, you deserve it, and go have some fun, all right? So estimate retirement income and expenses. The next thing is planning for long-term care. And the sooner you start planning for long-term care, the lower the cost should be. In a lot of cases, if you wait too long, you may find an issue with insurability at all, okay? But it's something to think about because we have a 1 in 2 chance of needing long-term care, which means one of the husband and wife team, all right, will probably need care at some point in time in their life. Now, there's a plethora of ways to deal with long-term care expenses. You can self-insure, and if you can spend, $300,000 over a 3-year period, $100,000 a year over a 3-year period, you might be in a position to where you can self-insure, provided that if that money was gone out of the portfolio, the surviving spouse could live the same lifestyle on the remaining amount of funds in the portfolio, the remaining amount of income, Social Security or pensions or whatever it may be. That's an ability to self-insure. If that's you, that's awesome, all right? In another instance, you may consider a hybrid situation. A hybrid situation is a life insurance policy with a long-term care rider on it. You do have to qualify for these, but in some cases you get the benefits of having a death benefit, so someone gets paid, right? And if you don't use the long-term care benefits, but if you do need the long-term care benefits, they're there. And there's a lot of those options out there. And a lot of people say, Ryan, I'm too old to buy life insurance. Well, if I'm buying the life insurance, not for the life insurance death benefit, I'm buying it for the long-term care benefits, and it's cheaper than buying a long-term care policy. I mean, we absolutely have to evaluate those options for sure, all right? And lastly, if you're someone who may not be insurable, we can look at something called asset-based long-term care or an asset-based long-term care annuity strategy. And what that means is that you don't have to qualify for these. You just invest a lump sum of cash. You're getting payments from that annuity. In the event you go into a long-term care facility or need someone to come in your home and take care of you, those payments will double while you're under that duress. But there's just a few options to think about. And some people might say, Ryan, I don't like annuities, or I don't like life insurance. Well, folks, listen, if you're concerned about long-term care and that vehicle solve the problems, it's a tool. It doesn't matter what it is. As long as it accomplishes what you're after, that's what matters the most, all right? Next thing, adjust your portfolio. And this is hard, guys, because if I say to you, hey, you're 55, you're 55, you've got $2 million. I think with Social Security, you've got it made, right? So meaning if we stay invested the way we are, we're aggressive, and all of a sudden the stock market drops by 50% and, at 56 years of age, well, clearly you don't have $2 million anymore. You got $1 million probably now. And now you're in a situation to where you've got to delay retirement and you've kind of lost control of things when you had it made. That bothers me. I couldn't imagine, the feeling of being 55 and I've got it made and I stay too aggressive, right? And the market crashes on me. Now I've got to push retirement out until the market comes back. That's a pretty aggravating and frustrating feeling for sure. And quite frankly, I feel like I lost my financial peace of mind and security and probably some confidence along the way. So that's one side of it. But the other side of it too is to say, well, hey, let's get way more conservative. And all of a sudden the stock market runs up, a ton. You're going to go, well, Ryan, I missed all the stock market gains. I could have had $3 million, right? So it's a balancing act. But one of the things to think about is this. When we're talking about in point two, the expenses, non-discretionary versus discretionary expenses, if you don't want to reduce the risk, all right, and that's okay if you don't, consider taking a portion of money and putting it into something that guarantees those expenses, non-discretionary expenses, as long as you have breath in your body, and leave the rest of the money out there, but at the risk level you got it. Just a strategy. And the reason why I say that is if you've got your non-discretionary expenses covered, as long as you have breath in your body, you're going to have some quality of life, some baseline quality of life established going through your golden years. And the other money you've got out there, if you take a hit, and it takes 4 or 5 years to come back, 6 or 7 years to come back, you still have that pot of money, and you still have the growth in that money. You can still go out and do stuff and enjoy your golden years after the portfolio recovers, and maybe you'll retire, pretty close to when you wanted to, maybe a 2-year delay or something like that. But it's just something to get you thinking that I don't want you out there exposed overly to risk, all right, and have the market crash. But by the same token, I don't want you to be so conservative we don't get you where you need to go and get you the assets you need, because the market can in fact be a phenomenal tool for growth if invested right and at the appropriate risk levels. All right. So last one is one that I see it's a big mistake. And I say that because, I see people, they retire, they roll the pension over, they roll the 401k over, and they keep it at the same company. And I'm not knocking the company that I'm about to say in any capacity, because they're a phenomenal company, but they keep it like Fidelity, right? And they say, been with Fidelity, this has been my 401k plan for 30 years. I roll my pension over there, and then they stop. They talk to the Fidelity people. They don't really like what they hear a lot of times because the Fidelity people are more working for Fidelity, not them. That's not a dig on Fidelity, by the way. It's just the way it works. But what they start to realize is, let's go consult a financial advisor. Don't wait until you actually retire to consult a financial advisor. The moment you should start thinking about talking to a financial advisor is the first time retirement or when you're going to retire crosses your mind. And there are so many types of advisors out there that can help you. There's advisors that will charge a fee on your assets. You invest with them to manage your money and help do all the financial planning services that can go along with that. Some advisors will just charge you a straight fee to say, hey, for $300 an hour, it takes me 2 hours to whip one up, 3 hours to whip one up, whatever it is, I can actually build you a financial plan, and we can review that on an annual basis and kind of see how you're going. And then some people do it a hybrid way. They charge fees on the financial planning side, and they charge fees on the management side. Whatever it is, all those fees should be disclosed to you up front so you know what you're paying. But most importantly, engage that person before you retire, not after, all right? And the important factor is if you're 5 years out from retirement, for instance, you've gotten to know that person. You've got to know whether or not they're the right person for you. You may change that advisor out, after being with the advisor for 2 years because you're not jiving with them, or they, you don't like what they're doing, or you don't like the communication to provide, whatever it is. But you've got some time there to really vet, all right, and do some due diligence on some advisors out there to find someone that can work well with you in your golden years. And I promise you, folks, as advisors, we do offer a tremendous amount of value to the clients and prospective clients we work with. So please engage, much sooner than later. There's things that we know how to do and levers we know how to pull that you may not know that maybe save you thousands and thousands of dollars in taxes, make you get more out of the Social Security system, save your kids' taxes. There's just a lot of stuff that we know how to do that the average person who doesn't do what we do know, right? And so, folks, that's 5 things that you should consider before you retire, all right? So if you're, 5 years out, 10 years out, even before retirement there, these are 5 things you can consider. But most important, folks, and the most important thing here is the moment you start thinking about retirement, consult a good financial advisor. Well, thanks so much for tuning in, folks. I'm Ryan Wheelis, host of the On the Money YouTube channel. If you like the content we're putting out, hit the like button down below. Also, give us a subscribe, and we'll keep updating you. We put out awesome content just like this.